Are you considering buying a house? Beware, as the housing market is poised to become increasingly complicated. Experts are warning of significant issues on the horizon, potentially surpassing the challenges of the 2008 crisis. While interest rates are currently stable, there are indications they may decrease in the future. However, home prices continue to rise while sales lag, and obtaining loans for housing has become more costly than ever before. This shifting landscape may reshape perceptions of the housing market, presenting a volatile blend of financial patterns and individual aspirations. Reflecting on the events of 2008, when the housing market crashed and wreaked havoc on the economy, offers insights into the factors at play. The crisis was akin to a perfect storm, with several elements converging. One crucial aspect was the prevalence of subprime mortgages, wherein banks readily extended loans to individuals who were unlikely to be able to repay them. These risky loans were then bundled and sold to investors, exacerbating amidst the eventual mortgage defaults. The once booming investments took a nosedive. Numerous homeowners, initially enjoying low mortgage rates, found themselves grappling with skyrocketing payments. As financial strains tightened their grip, a cascade of foreclosures ensued. The regulatory landscape, once safeguarded by laws like the Glass-Steagall Act, witnessed a seismic shift post-1999. With its repeal, banks embraced risk with abandon, triggering a domino effect of loss. Homes, jobs, and businesses all fell victim. The global interconnectivity of financial systems magnified the impact, as the collapse of US banking giants reverberated worldwide. In response, the government marshaled extensive interventions, from the Troubled Asset Relief Program to aggressive monetary policies by the Federal Reserve. The scars of the 2008 housing market crash ran deep, as evidenced by the precipitous decline in US housing prices. Prior to the crash, a feverish surge in housing values swept the nation, only to be followed by a gut-wrenching plummet. According to the S&P Korelogik-Kasse Schiller Home Price Index, prices tumbled by a staggering 27.4%, from their zenith in 2006 to their nadir in 2012. The pain was particularly acute in states like Arizona, California, Florida, and Nevada, where the housing boom was most fervent, culminating in a harrowing drop of over 50% from their peaks. So, what's causing this market instability? To start, there's a surplus of houses for sale at the moment. Existing home sales dipped by 1% in December compared to the previous month, and by 6.2% from 2022. The end of 2023 saw existing home sales plummet to 4.09 million, the lowest in 28 years, according to the latest data from the National Association of Realtors. However, the challenges facing today's real estate market may be even greater. House prices have nearly doubled since 2008, driven by increased demand from millennials seeking to purchase their own homes. Additionally, the rise of remote work has enabled people to live anywhere, leading to increased demand for homes in suburban and rural areas. Despite this high demand, new homes aren't being constructed quickly enough, and existing ones aren't selling as rapidly as anticipated. It's a peculiar situation where there's a desire to buy homes, but the available inventory isn't moving. A significant concern now is that with mortgage rates surpassing 6%, fewer people are interested in buying homes. Remains, is our safety net robust enough to withstand potential market downturns? Amidst this uncertainty, renting has become increasingly challenging, with rent prices soaring by 29.4% since the onset of the pandemic. For many, homeownership seems out of reach, exacerbating the rental crisis. Curiously, despite a surplus of 8.2 months' worth of new houses, the market remains skewed. We're witnessing a paradoxical situation where an abundance of homes coexists with sky-high prices. Surprisingly, the median price for a new home stood at $432,000 as of December 2023, far outstripping the average income for most individuals. While the S&P CoreLogic Case-Shiller Index's 15.8% increase in July might suggest positive growth, it actually signals a deceleration. Zillow's data confirms this trend, showing a halt in price escalation for the first time in a decade, marking a significant shift in the housing market's trajectory. However, there's a glimmer of hope amidst the uncertainty. Moody's Mark Zandi predicts a modest price correction of 0 to 5% over the next year, averting a crash, but not entirely reassuring. Roger Ashworth of Goldman Sachs acknowledges our stability in some aspects, but underscores the persistent issue of affordability. Disagreement among experts abounds regarding future trends. Goldman Sachs raises concerns about overheated markets like San Jose, Austin, Phoenix, and San Diego, where conditions could spiral out of control. Moreover, with interest rates climbing, there are forecasts that the 30-year fixed mortgage rate could hit 6.5% by year-end, further complicating the housing landscape. Despite the prevailing challenges, there are some silver linings. According to the National Association of Realtors, home sales have decreased significantly, almost 20% less than last year. This suggests that house prices might start to decline significantly. Imagine it's the mid-2000s, and acquiring a house is as simple as buying new shoes. Credit is readily available, and everyone wants a piece of the action. Then comes 2008, the market crashes, and it's total chaos. But we learned our lesson. Lending rules became stricter, no more easy loans, and people obtaining mortgages are less likely to default. Sounds good, right? But even with these safety measures, we're still not on solid ground. As we transition into 2024, the economic landscape is shifting. Inflation remains high, people are accumulating more debt, and credit card late payments are at levels unseen in over a decade. Amidst all this chaos, mortgage rates are behaving unpredictably, no longer declining as they once did. If a recession hits in 2024, as some anticipate, don't expect these rates to provide much relief. Even a minor recession is unlikely to significantly lower them. This is where things take a turn for the worse. High mortgage rates, coupled with expensive homes, could deter many from buying. Although concerns about a housing market crash linger, not everyone believes it's imminent. Many experts anticipate a correction rather than a complete collapse, supporting the housing market. While she doesn't foresee a crash in 2024, potential challenges lie ahead if jobs become scarce and recession sets in. Moreover, if commercial property values continue to decline, homeowners may face higher property taxes. So what's next for the housing market? Market experts anticipate a calming down. They expect mortgage rates to decrease from their elevated levels. This, along with slower home price increases and sustained demand for homes, is likely to entice buyers back into the market. But what about selling homes? Some homeowners who secured favorable mortgage deals during the pandemic might opt to stay put. Additionally, since people are living longer, homes aren't changing hands as frequently. While new homes are being constructed, it's insufficient to meet demand. If you're not ready to buy a home yet, utilize this time to prepare, save diligently, work on improving your credit score, and explore different living options. Keep a close watch on the market. When mortgage rates decline, many may jump back into the market, potentially driving prices up once more. It's crucial not to be caught off guard. We're amidst uncertain times, so stay vigilant for changes. Shifts in the economy and housing market could impact everyone's ability to purchase a home. Don't forget to like, share, and subscribe to our channel for more insightful videos. We'll return with more content soon.